while it can be frustrating that you're not in the faster running market, it doesn't matter because you can still find setups. So by having this outlined experience where we know that the market is likely to draw on these higher time frame premium arrays, that means it's going to go up. How do I engage with it? Well, how do I teach you? First, start looking for one good setup per week. Just find one good setup, not an everyday setup. Because if you can find a setup that you can find once a week, that same model, that same approach that you use for that one setup that you've been waiting for one period of trading inside of an entire week, you're going to forge discipline, self-control. You will get your ends met by that. And because you're getting experience with it, you can take that and reduce it to a smaller time frame, and you can find more of that same model in formation across the entire spectrum of the week. Silver bullets exist in many runs, but I just gave you a very specific time when they form every day. But unless you know where the market's going to go, it's highly unlikely that you're going to be consistent with it, because you're just going to be guessing, and you're going to look at every little separation between three candles and think it's a fair value gap that it's an entry on, and it's not. You still have to know where the market's likely to go to. Now, devil's advocate, say we were long and it wasn't a CPI day. It was just a normal every run-of-the-mill day, and we went long, and everything behaved as we see here. We were taking partials here. We were taking majority of our trade off in here. The stop would have remained below the opening price at 8:30. When the market started making its run, let's go back into a 1 minute chart. Here's your 8:30 opening price. You would still have your stop, or it would be below this opening price initially. Get this scrubbed up here a little bit. This wick, consequent encroachment would be in here. Your stop would have to be below that. But ICT earlier, you said it doesn't need to go down. It doesn't need to go down there, but it can revisit the consequent encroachment. It can. 8:30 is when the news embargo lifts. That means there's going to be volatility. It's going to get up and down. Not to this magnitude, because CPI is a little bit more aggressive. Think of it like non-farm payroll. It can be a little bit more wild or more animated. So, or if you want to be very conservative, your stop loss, again, you're trading for the daily range. So that means you're not trying to do your 30 contracts, your 40 contracts, max position, okay? You're trying to trade the daily range, where you're trying to maximize the availability of the full daily range. Your stop could be placed below here, minimum consequent encroachment. So let's give you the specifics on that. So stop loss would have to be below 43.88 and a quarter, which is so close in proximity to 43.87 and a quarter, which is the low end where I told you the sell side liquidity resided, which is relative equal lows here. And the, not that one, sorry. Here. And again, I mentioned the buy side here. So we've already worked that sell side. So how do you place your stop loss and feel confident that it's not going to hit it and knock you out? If you're trying to day trade, day trading is position trading for the daily range. Intraday scalping is session trading. That means you're trading the morning session before lunch in New York, and in the PM session. There's a distinction there. When I say day trading, what I'm saying is you're trying to capitalize on the majority of the daily full run from open to close. You're trying to get the lion's portion of that move. That's not scalping, that's day trading. Scalping, or intraday scalping, or session trading, is where you're getting in and out, typically many times within the same hour or so, or 2 hours. How do you trade that ICT versus when you're teaching us recently in the last year or so, when I'm doing my examples? I'm teaching you how to operate inside of the session, whether it be the morning session or an afternoon session, whatever one I'm trading in at the time. I'm capitalizing the move that I foresee that would be just the lines portion of that specific session of the day, whether it be London session, New York session, or New York PM session, whatever it is I'm trading, it's relative to that specific session. If you want to capture larger runs on price, then you're going to leave your stop loss, which I know some of you don't like that. It makes it terribly fearful that leaving a stop loss while the market's running all the way up here and up here, your stop loss would still be below the opening, because you won't learn how to place stops and move stops effectively in the beginning by trying to move them tight or try to see what I do. Like when you see me do that, it always comes with a price. Invariably, if you trail your stop loss, it will be hit eventually. It will absolutely be hit. My stops get hit. When they're trailed up, eventually, boom, it gets out. But I have taken the majority of my trade-off in profit before that even happens. So when I do those examples, I'm teaching you how to graduate into that. Now, I know if I want to be in a day trade, if I think the daily range is going to expand and close near the high of the day and I'm bullish, then I'm not going to need a rush to move my stop loss. It's going to stay where I initially place it. And I'm not worried about reducing its exposure, because throughout the day, what am I doing? I'm taking partials to pay me, which is by default, it reduces the exposure that you would have with the stop loss at or below the low end of that range, which would be down here. There's no need for it to come back down here. It's already done the damage. And traders are not going to be wanting to go in here, go long, because they seen this big wick down here and it wicked here. Now they're scared. And they don't understand what you're being taught, that the first run on liquidity is the tip. That's the signature that you're looking for. If you want to be long, the best time to go long is after sell stops have been taken. I've said this in old videos on YouTube. Some of the videos aren't even on my YouTube channel anymore. Where are those videos? You're hiding stuff. It's just, they're old. The production quality sucked. But the things I talked about, even when I was on Baby Pips, many of you let it go in one ear out the other. But it's still true. So if you're looking for bias, you want to learn how to do daily bias, it starts with understanding where that weekly chart is likely to go to. That's the first thing you have to decide. Is it going to more likely go up on the weekly candle or down? Why would it be wanting to go higher or lower? That's what I've been showing you. That's what I've been putting your attention to on that weekly chart. And every time it starts to go low, intraday charts on 1 minute, 3 minute, 5 minute candles, you see people out there trying to chase it like it's going to go lower. And it's only going down to present new buying opportunities. That's all it's doing. It's going into the discounts. So as a day trader, you could be still long. Your stop loss will be below the low end of that dealing range, where sell side was already tagged. Lion's portion of the move would be off here, and you would have taken partials above this high here as well. You would not, as a day trader, put your stop loss below that low. Why? What do I teach you about the lunch hour? Lunch hour macro runs on liquidity. What liquidity? The stops that would favor the folks that have been profitable all morning long going into New York lunch, they have trailed their stop loss because they don't want to lose open profit, when really they're guaranteeing no potential further open profit, because the market will, in fact, many times go down and take out the low of the day that was formed prior to 11 or noon New York local time, they'll take those stops. When does it occur? Between 12 o'clock New York local time and 1:30 New York local time. Don't believe me? Go into your charts and see if it's what's going on. I don't want you to believe anything I'm saying. I want you to go into the charts and back test and look at that stuff, because you will see it. You won't need to hear me say it all the time. It will be in your notes, and it'll be part of your repertoire.